Howdy, Jacob here. Today we're looking at our first company in the fundamental screener. Reminder that the criteria here is earnings per share growth, forward PE that's positive, and then return on assets, investments, and equity greater than 15%. The goal is just to see whether these companies are undervalued or not, and this will be an interesting screener based on a previous screener on dividend yield. All we really cared about was can they afford their dividend, and less really about the allocation of money. Whereas here is going to be, well, I'm going to be caring a lot more about what they do with their money and are they allocating it well. But in the back end, I really just care about value, or I don't just care, but in reality, valuation is the most important metric. But this should be a fun. This should be fun because if we see companies with great revenue growth potential, great earnings potential, great return on investment, great return on asset and invested capital, then we should have companies that we could hold for a very long time. And even if we buy them a little bit overvalued or maybe not as undervalued as we like, it'll just kind of grow into it based on the way that growth and return on invested capital kind of converge with each other to really exponentiate returns. So let's look at the first company, AAON. It is in the building products industry with market cap and enterprise value both just under $6 billion. Looks like they engage in engineering, manufacturing, marketing, and selling of air conditioning and heating equipment in the US and Canada. Founded in 1987. We see that there is a big growth over the last 10 years, huge jump in 2022. Wonder if that was acquisition related. And it might have been in 2021, there was $103 million for acquisition. That could be a big portion of this. But even outside of that, the growth has been well over inflation, likely averaging 4 to 5% a year. Their return on invested capital is still very great. We're looking at maybe 15 to 20% on a 5-year average basis, but it is down from 5 years ago. And same with both gross and operating margin. Still looks good right now at 14% operating and 27% gross margin. But 10 years ago, it was a little bit higher. Looks like this company does pay a dividend. It looks like it's not very substantial in relation to earnings per share. So that's good to see with their return on invested capital so great. Balance sheet looks pretty good. I mean, only $5 million cash on hand, but only $71 million in debt. In relation to their 5-year average free cash flow, that $70 million doesn't really look like much. So the use of cash flow looks like outside of this $103 million acquisition in 2021, their only use of cash has really been buying back shares and issuing debt, or buying back shares and issuing dividends. Sorry, and then they have been issuing debt, but that's not a form of capital allocation. That would be, and that they don't have the money to do that, so they issue debt. So here, I mean, on a 5-year average basis, we're probably looking at $50 million. And I mean, in relation to that $71 million in debt, that's nothing. Interesting though that they have such low cash on hand. Even if a company does produce positive free cash flow, it's always nice to have a little bit of reserve. Because, I mean, if you think about it from safekeeping, this doesn't necessarily have to do with present value of earnings and free cash flow. But I view it the same as an individual. Like, would I prefer somebody who makes $100,000 a year and has $1,000 in cash, or $100,000 a year and has $15,000, $20,000, $30,000 in cash on hand? I mean, you just know that the person who has $30,000 could withstand more variance than somebody who doesn't. And I'll say a salary is a lot more reliable and such than earnings on a company for the most part. If you're a good worker, then yeah, that's true. So that's interesting. I would say that capital allocation wise, we're seeing about 40% to dividends, 40% to buying back shares, and then maybe 20% on an average basis to acquisitions. I would say that we want this company to be buying back shares when it's stupidly cheap, and it looks like this is the type of company that just kind of consistently buys back shares. and they've actually been buying back less recently. We'll have to see whether it's cheap or not now. But yeah, I mean, looking at the past, you don't necessarily see if it's cheap because you're looking through 2020 because hindsight's 2020. But you would have wanted to see them likely buy shares down here at 35, sub 35, maybe. We'll see if it was. We'll see if that's actually a good price or not. But looks like they've just been consistently buying back shares. There's nothing wrong with it. I mean, a company like Google or Apple that does it, they've really gone up. Their stock price has gone up 15% plus each year. And so for them to dollar cost average, maybe at some points they're buying with like 10% return, and others they're buying back at 25+% return. And so, I mean, you usually want it to be obviously cheap, but if it's a great company, I know that Warren Buffett has said this on Coca-Cola, like there really hasn't been a time in history where it was actually a bad time to buy back shares. And so for companies with great returns on invested capital, it's similar where you want them to be reinvesting into the business because they get such a good return on it. But a company's stock price like just goes up, goes up, goes up. It's not a terrible idea to just constantly be buying back shares. It's the same with individuals buying back or buying the S&P 500 month in, month out, day in, day out, whatever it is. Dollar cost averaging. It's a similar concept. But to me, the allocators of a company should be held to a higher standard than the average person. And I mean, you don't see Warren Buffett dollar cost averaging the SPY. He buys, or even companies for that matter. When it looks like a great deal, he buys it. So he's probably the best capital allocator out there. And so again, not necessarily bad, but you want them to be buying it when it's obviously cheap, and we don't necessarily see that here. And as for this dividend, I mean, I don't really care. Now that we're done with the dividend yield screener, I don't really care about dividends as much. If you're looking just for companies that are going to grow as much as possible, you want them to be reinvesting back in themselves. And you don't want to get taxed. You just want to leverage that growth as much as possible through share repurchases and reinvestments. And so it doesn't look like there's too much reinvestment going on here. It looks like capital allocation is straight to buying back shares, paying out a dividend. Let's make some assumptions here. I would say that growing with inflation is probably a pretty accurate statement. And we do see return on invested capital. We'll probably see me do higher P's and free cash flows than I've done in the past, but probably lower than pretty much every YouTuber out there just because I'm a conservative individual. And my understanding of P and price free cash flow will be at the end of 7 years, what does that growth and what does that return on invested capital look like? And if there's a high return on invested capital but no growth, then you really don't deserve any sort of prowessing P and price to free cash flow. So I'll say maybe 14, saying that they'll still have growth in 7 years. And then for margins, I don't like that free cash flow is lower than earnings. That's a little bit concerning to me. But for now, and how much share issuance do they have from share-based compensation? Okay, so share-based compensation recently has actually been greater than their stock repurchases. So their stocks have actually been flat. I'll probably assume that's fine to me. And then their dividend was fine. I don't see a reason to add to it. Really, it says it's a buy right now. So I guess I'll be doing. Wait, AAON says it's $75. Oh, I know. Okay, so it's not necessarily a screaming deal. This is the current price. This is okay. My bad, everybody. Okay, so yeah, definitely not a screaming deal right now. The company's price would have to fall 84%, given to get a 15% return given these assumptions, that makes a lot more sense. So hopefully everyone enjoyed the video and enjoys my fundamentals review of companies from now on.